We're diving immediately into an analysis report that evaluates ON Semiconductor's position as a premier value chip play for 2026.
It is. A position supposedly driven by its silicon carbide leadership, its strong cash flow, and some pretty compelling analyst targets.
Exactly.
And the core data here is really strong, but I think we have a crucial opportunity to elevate the delivery. So let's get straight to the first point. To maximize the impact and perceived authority of this analysis, the language and presentation style should align more closely with serious financial research rather than, say, promotional media content.
Okay, I can see what you're getting at here. The report uses this highly energetic and sometimes sensationalized language.
Right.
You've got sections titled The Hook and Final Verdict, and phrases like chasing the AI hype train, and that title is on the best chip play for 2026. It feels a bit like clickbait.
It does.
And that framing, I think it really risks undercutting the seriousness of the financial data, like that impressive $372 million in free cash flow they cite.
Absolutely. And the problem isn't the energy. The problem is the friction. The author has put together these great fundamental figures, that 23.5x forward PE is mentioned, but when you frame it like a piece of engagement media, it instantly raises questions for sophisticated reader.
The kind of reader who expects objective insight.
Exactly. The whole thing would be strengthened immensely just by adopting a more measured, more objective, analytical tone. We need to remove that promotional framework and let the structure just clearly organize the financial analysis.
I see the point, but hold on. Doesn't removing all the AI hype language risk losing some of the generalist readers? The ones who do follow those trends? I mean, we need to balance the objective tone with some accessibility.
That's a fair challenge, but this is a deep analysis report, not a social media post. We have to focus on attracting the reader who is here for rigorous valuation. It's really all about setting expectations.
Okay.
You wouldn't wear a novelty tie to a board meeting, right? So you shouldn't slap a YouTube-style title onto serious financial research. We could immediately increase the intellectual weight just by reframing that title from a question to a declarative thesis.
So give me an example. How would that work in practice?
Well, instead of asking, is ON the best chip play, you establish the intent immediately. A title like ON Semiconductor, Assessing Strategic Value in the 2026 Auto-Industrial Cycle.
Right.
That tells the reader exactly what they're getting. It's a detailed, long-term valuation focused on their main market driver. That alone elevates the perceived expertise here.
And what about those punchier lines, like the one about the get-rich-quick AI trade?
You swap them for direct analytical comparisons. If the thesis is valuation, focus the reader there immediately. Instead of talking about AI hype, just jump right into comparing ON's 23.5x forward PE to the multiples of its peer group.
So companies like Texas Instruments or Analog Devices.
Exactly. The big industrial powerhouses. If ON is trading at a significant discount to those guys, which it is, that comparison should be the first financial hook, not some throwaway comment about speculative trading.
I also noticed the flow kind of works against the core argument. If the entire thesis rests on ON being a value play, why is the detailed valuation discussion buried so late in the report?
That is a critical structural fix. Right now, you get the bull case, then analyst targets, and then finally valuation. If the core argument is about a strategic discount, you have to move that section on valuation up.
Put it right after the fundamentals.
Immediately after. Present the fundamentals, like the $1.55 billion revenue beat and the strong cash flow, and then immediately establish the discount argument. When you lead with the fact that this dominant player is cheaply valued, the whole case just becomes sharper, more logical, much more impactful.
So if we elevate the tone, we're really just letting the numbers do the talking.
Precisely.
And the biggest advantage here, seems to be silicon carbide. But I feel like the material only just scratched the surface, improving that dominance.
That's a perfect transition, because that's exactly the substance of our second critique. While the report correctly identifies silicon carbide, or SiC, as a key strategic advantage, quantifying and detailing the specific nature of ON's moat will significantly strengthen the bull case.
The argument for the SiC moat is strong, I'll give it that. The report positions ON as a dominant player for EVs, for charging infrastructure. But it doesn't really articulate why ON is dominant compared to its competitors, like Infineon or STMicro. It establishes the result that they're a major player, but not the cause. How hard is it for others to replicate their position?
Exactly right. The moat feels asserted, not proven. To really solidify the investment thesis, the report needs to bring in specific data points. Talk about proprietary technology, their scale advantage, or, and this is crucial, their long-term supply agreements.
The LTSAs?
Right. Those are the things that restrict competitors and lock in future revenue. We need to show that this moat is tangible and defensible, not just a temporary lead.
The report does lean heavily on their move toward vertical integration in SiC production. That seems to be the key differentiator.
It is.
So if they have this massive captive manufacturing volume, what are the capital constraints on competitors trying to catch up in the next couple of years? Is that investment even feasible for them?
That is the exact question the report needs to answer. The primary competitors need to be named, discussed explicitly. Who are the rivals here? What specific tech, or cost, or manufacturing advantages does Anza actually possess that keeps them ahead?
So it's not enough to just say they're big.
Not at all. I mean, if Anza has optimized their SiC substrate slicing technology, for example, and they're getting lower defect rates or higher yield, that needs to be quantified as the proprietary advantage.
And I guess proving the scale of that dominance is vital for the whole value thesis.
Absolutely. You have to provide context, detail how ON's captive manufacturing volume compares to the rest of the industry. You need to show that vertical integration in actual numbers, like output volume or cost per wafer. That's what establishes how hard it is to replicate.
Because competitors can't just flip a switch.
They can't. Building that kind of capacity involves massive, multi-year capex cycles. That's a powerful barrier to entry. And that data point helps justify the premium the stock should eventually command.
And since the whole analysis is aimed at 2026, we need to think about how long that advantage will last. Current dominance is great, but investors are buying future earnings.
Definitely. The report has to analyze the longevity of this SiC advantage. Is the current lead based just on first mover timing with the current tech? Or does ON have clear, patented process innovations? Things in wafer size, efficiency, packaging.
That will secure its position through 2026 and beyond.
Exactly. Showing the moat is engineered for the long term, that's what strengthens the conviction needed to actually hit that aggressive $85 bull case target.
All right, let's move into our final area of critique. This report lays out a strong bullish roadmap, but, well, any comprehensive financial analysis is strengthened by rigorous stress testing. The best analysis has withstood its own scrutiny.
It has to. And that brings us to the third point. A comprehensive analysis report must dedicate appropriate analytical space to risks and potential counter-arguments to fully establish the robustness of the bullish conclusion.
That's non-negotiable for serious investment analysis.
It is. But the current structure is so heavily focused on the upside, that 55% gain target, the revenue beat, the FCF, it really minimizes any discussion of potential challenges.
The only counterpoint mentioned is the bear target of $50.
Right, but the material doesn't explore the actual drivers. What would cause the stock to go back down to $50? That's a massive analytical hole.
It sort of feels like the report is asking us to trust that the risk is limited, but it doesn't show us why the bearish view is flawed or temporary. I think that lack of stress testing might be the biggest red flag here.
I agree.
If they don't account for, say, an EV slowdown, their entire 2026 premise just falls apart. And that feels like a huge vulnerability that the report just glosses over.
It does. And a failure to address the downside makes the whole conclusion feel fragile. The report needs to integrate a dedicated, detailed section on risk factors and counterarguments. It shows the reader that the conclusion has withstood scrutiny from other perspectives, and that increases confidence in the whole thesis.
So how do we make that risk section more powerful, more than just a simple list of boilerplate warnings?
We need to analyze the underlying market concerns. So when we talk about cyclical risks, the industrial semiconductor sector, it breathes in and out. The report assumes the breathing out, the inventory correction, is over.
Enabling the 2026 recovery?
Right. But instead of just stating the $50 bear target, the report should explore the specific risks there. What if that inventory correction is delayed? What specific economic metrics, manufacturing utilization rates, key customer earnings, what would indicate that the 2026 supercycle recovery won't happen on schedule?
And that reliance on EV growth, that's a massive single point of failure that needs a much deeper discussion.
It is. The thesis rests so heavily on the assumption that EV adoption stabilizes and grows. The analysis has to challenge this directly. What if key EV manufacturers shift strategy? Maybe they favor hybrids for longer than expected, or face huge pressure from low-cost rivals.
And that slows the overall demand for high-performance SiC chips.
Exactly. How would that demand shock specifically impact Owen's revenue forecast for 2026, especially since they've built out so much captive capacity? You need that sensitivity analysis.
And finally, the report leans into this short squeeze potential, mentioning the 10 to 14% short interest. That implies sophisticated investors are actively betting against the stock.
That short interest is a flashing sign that the market sees problems the report is ignoring. So if the thesis is going to include a short squeeze as a catalyst, the report must examine the factors that are supporting that short position.
And then explain why they're wrong.
Or temporary, yes. Are shorts betting on poor industrial earnings, SiC commoditization, maybe execution risks with the big CapEx build-out? Addressing those specific bear arguments strengthens the bullish conclusion because you're actively refuting the most critical skepticism already priced into the stock.